So as a result of the closure of the Strait of Hormuz, 1/5 of global crude oil supply is constrained, 1/5 of natural gas exports, 1/5 of refined products, so gasoline, diesel, jet fuel, over 1/3 of helium supply, over 1/3 of urea, which is used in fertilizer, over 1/3 of sulfur, which is also used in fertilizer. And there doesn't seem to be a path to near-term de-escalation. On crude oil, globally, refineries rely on the crude oil that comes out of the Persian Gulf. It is a specific grade. A lot of it's medium sour. It's very hard to replace that. No two barrels of oil are created equal. And you can't simply run a barrel of light sweet from the US and replace a barrel of medium sour from the Persian Gulf, because what you put into a refinery determines what you get out. So additionally, the cost of crude oil has gone up, which means the cost of refined products has gone up. On refined products, the Middle East is also a major refining hub, and refined products are now shut in because they can't transit through the Strait of Hormuz, which means globally, we're also short refined products, in addition to the input costs being much higher. On natural gas, we export as liquefied natural gas. 1/5 of global supply transits through the Strait of Hormuz. 1/5 comes from a single plant in Qatar. We're exiting winter now, which means that we're at a point where Europe in particular is starting to refill inventories ahead of next winter. And now with the shortage of supply, they're competing for cargoes against Asian customers. So it's driving the price of natural gas up. Which is also problematic for transportation fuels because natural gas is also an input for distillates like diesel and jet fuel. So more pressure on refined products and more pressure on transportation fuels. There are two challenges ahead. The first is that we don't know the duration of the conflict, and the longer it goes on, the more we exacerbate the challenges ahead and potentially the price of commodities. The second is that even if we had de-escalation tomorrow, it will take a long time for us to resettle flows. We're not sure the extent of the damage to facilities like refineries or LNG plants or export terminals. It will take a long time to rebalance flows of cargoes going through the Strait of Hormuz. So the uncertainty is driving a lot of volatility in commodity prices as well. Conflict like this emphasizes security of supply, safe jurisdiction, and asset quality. Canadian heavy oil producers possess a lot of the qualities that we look for. They have asset duration, they have reserves that's measured in decades, not years like other producers, particularly shale producers. They're low decline, so the assets don't decline as rapidly as US shale, for example, which means they have to spend less capital to maintain production. These producers also produce substantial free cash flow down to $50 oil prices, some even below, and their balance sheets are clean, which means that when we go through commodity price spikes like this, the incremental free cash flow accrues to shareholders through more dividends and more buybacks. They're more resistant to putting capital to work in the ground to rapidly grow production. They're more sustainable through the cycle. So we look for companies that have the asset duration, high quality management teams, and a strict adherence to free cash flow or shareholder returns, because we get better returns through the cycle as opposed to just during commodity price swings. Vulnerability of supply really highlights asset duration and quality, which is why we expect to see a premium valuation in Canadian energy. Moving forward, if the duration remains prolonged, that places more emphasis on asset quality and duration, which should benefit Canadian energy producers, as well as the oilfield service companies that help them develop those reserves.